Hello traders, Gary Wagner here just after 10 o'clock in Honolulu, 4 o'clock in New York on Thursday, 18th day of June, 2015, and this is Trending Markets. And there is no doubt action in the marketplace today following the conclusion of the FOMC meeting and ensuing press conference that was yesterday have now been digested in the market. Votes are in and the equities markets are on solid footing, moving back to record territory, which is a very interesting scenario because a break above the most recent record tops would certainly be signaling a breakout. We got that in gold today as it broke through its range and closed above 1200. The question is, are we going to see continued follow through in the equities markets? If they do, as I believe they will, go ahead and retest recent historical record highs. But before we cover the equities markets, a little bit of housekeeping. I did put out a high-risk trade alert a few days ago to go ahead and short the euro. My anticipation was the breakdown in talks between Greece and the EU and the IMF should put some pressure onto the euro. However, recent statements by the Fed put more pressure on the dollar as the dollar came down. Euro has been moving dramatically higher, now well off of the highs, trading at 113.70 in that area. But the high today was 114.36. We had stops in at 114.05. As much as I hate to announce it, we were stopped out, anyone that took that high-risk trade. We'll talk about where we think the euro dollar is going in a second, but the big news to me today is absolutely the U.S. equities markets. Now, there's quite a few ways that we can go ahead and look at this, and I want to start with a fairly short-term chart. This in the Dow Jones Industrial Average, and it's Japanese average format, but really what I want to look at and focus in on is just as we did in gold a little while ago on the gold forecast, where we looked at our current shorter-term channel lines. The market had defined downside pressure, no doubt. You can see the market moving from these tops here in the Dow Jones Industrial at about 18,350. From there, we had a steady decline in the market. There were a couple of occasions where it did trade above, but then followed right back by moving back into the channel. That does not seem to be the case now, as we can see a defined breakout and absolute close above this particular area. That, to me, signals a definitive opportunity, a definitive move to the upside. We'll have to see what kind of follow-through we get because we do have some expirations coming in, and historically speaking, that has put pressure onto the market. So the question that we're going to really want to pose in terms of our interim view of the market is, should the market come up and test these areas, will it once again bounce off of them? And that would tell us that we're still fairly range bound within the market. In other words, it comes up, it tests those most recent highs, but then just tends to move back within the range. Or will we see for the first time a break above these historical highs? Now, traders realize this is an extremely long-term view. I'm using a monthly chart here, but it's just to really show you the dynamics that we have seen in the market. And the reason that I'm also using Japanese average as opposed to standard candlesticks is the one thing the Japanese average does is it filters out noise, giving us a really solid sense for the strength of a trend. And the way that we determine the strength of a trend, of course, on a Japanese average chart is body size, because the open is always where is the midpoint of the prior month. That is always going to be your open for this monthly chart here. As the market's gone up in terms of our count, we've gone through a 5 count, but a double 5 count. In other words, if the market's in a defined bullish trend in which you have 1, 2, 3, 4, hits the top at 5, this becomes a larger one, and you repeat that 1, 2, 3, 4, and 5. And then again, we repeat that 1, 2, 3, 4, 5. It will continue to move up like that. Now, you can see there have been extreme points during this rally, the sustained rally. Rally really begins after the financial housing crisis came in at around 2008. The market bottoms out 2009, and from there you've got pretty decent body size. You have this small correction here, larger correction here, and very, very shallow corrections. Very few times over the last few years, realize we're going back 2010 and 11, in which you had any kind of release, so to speak, and this market's just been runaway. You then get the body size moving larger, meaning that trend is really picking up some steam, and then the most recent sets of corrections, I'll say consolidations, because these aren't really corrections but consolidations in the market. You can see that they haven't even gone red, but the body size really compressed. So you've got the body size compressing, meaning it's not closing that much above the midpoint of the prior month, but you do have a gain in terms of comparing it midpoint to midpoint. Much different than when we look at this in the standard candlestick chart. You don't get these consecutive greens. Now, we hit this top, and this top that we have been flirting with had its most recent record high last month right here, and that just succeeded the prior months in which you had record tops. So we have not the kind of huge momentum that will typically push it through to new areas on a sustained basis. But nonetheless, we are once again very close to flirting with these record tops. Dow Jones Industrial back above 18,000, and that, traders, as far as I'm concerned, is historic. So as we settle into our new service trending markets and we really start to recommend our different trades, the equities markets is going to be a big component of that. My sense right now is that depending on how the market reacts, I should say if, but I believe when it will retest this market, will determine whether or not we've really got a short play because it comes in, stalls at these tops, makes a high above it, but then begins to track back in. That would obviously signal a short. That's what the system is looking for. It is looking for a retracement or a correction. And at the same time, though, our corrections have been short-lived at best, but anything can set that off. You have a major collapse between the IMF and Greece and the European Union. That would absolutely have the potential to affect not only the European equities markets, but the global equities markets. But there's a lot of scenarios out there that could initiate a correction within the market. Or if it's all smooth sailing ahead and we have this defined breakout above in which our former tops now become our support rather than resistance, you've got an extremely good long play. Obviously, the way you want to play this market is from the long side with one tremendously large grain of salt, a grain of salt probably the size of a car. But that is the fact that really every roughly 7 years in the market, you have had some sort of a defined correction. Last major correction in the market, 2008. So when we look at 2008 to 2015, that would be 2016 would put us at that 7-year itch, so to speak. And we saw what happened last time. Let's go ahead and kind of extend our chart a little bit so we can account for that. And that is that the market had this tremendous dynamic move up as housing was just booming, loans were being issued like running water, and that whole financial scenario collapsed, taking the market from a former new high at around 14,000 and plunging it below 7,000. So we had a 50% decline in U.S. equities, and that occurred over a period of about a year and a half. So this is that 7-year itch, so to speak. We've seen it occur roughly every 7 years in the equities markets, and now we've had another 7-year run. So that to me is a tremendous caveat. There is going to be a tremendous opportunity should that correction begin and we catch that to be on the short side. And so that's something we absolutely want to be aware of. But history does not always repeat itself. And that being said, as this market has moved up, there are some real opportunities to capture. But we are A, at new record highs, and B, we're coming into that 7-year period. And so that's what we want to kind of always keep in the back of our minds as we look at the market currently trading. So what about the currency, specifically the dollar and the euro dollar? As you know, I am on record believing that long-term the cent or dollar, US dollar gaining value is still in play long-term. I'm also on record under the belief and assumption that we're currently in a counter trend or a corrective period in the dollar. I believe that the opposite is true for the euro dollar. We'll look at those charts in a second. When we look at our daily chart on the dollar, there is no doubt this is really called a hammer in terms of the straight candlestick that we're looking at right here. And what is significant about this candle type is it has made an extreme low in the marketplace, but has traded well up off that low. Now, what that says in terms of market sentiment, psychological market sentiment, is when it reached this point, whether it's short covering or buying entering the market as initiating positions, short covering is buying also, it was considered to be an extremely undervalued price point in the market, and the traders scooped it up and bought it up, so you saw tremendous short covering. We have these series of lows here at 93, and my sense is that we are absolutely getting fairly close to the conclusion of this corrective wave. We'll go into a dollar chart that is based or is a weekly chart so you can see the different areas that I'm looking at. Now, my sense in terms of the lowest low that I would see this market going to would be around 92.5. It's based on this 38% retracement. We have talked about this price point. We also, of course, have this series, this double bottom that came in, which is at about 93. And so when we look at the market right now as it currently sits, you can see that on this weekly chart, we did hit these lows that almost match this area. It also comes into our first level of potential support in the market. So we've certainly not seen the signs I thought we might see. I thought we would see the dollar possibly gain strength. We certainly did not see that. But I believe that we're very, very close to the conclusion of this corrective wave, because realize the market is corrected from about 100, now trading at around 94. So my sense is that we will re-enter and move back past this particular level, and that of course is a long-term observation in terms of our forecast. I'm not convinced now at this point that we've concluded the correction, but these are the levels that we're looking at, and we're getting very, very close to those price points. Now, as far as the euro dollar itself goes, my sense was that we could have hit a potential top. That's obviously not the case, but I still believe that we are very, very close to that potential top. We've already defined the strongest level of current resistance, which is at around 115.5. Market just below 114 right now after testing 114. When we take a look at this market after falling the level that it has in terms of the retracement, meaning this counter wave trend back up, I believe that this is the area we need to look at to determine when in fact it will then go under pressure, because my sense is what we will witness is the dollar getting stronger, the euro getting weaker. That would definitely happen if we see the current debt crisis in Greece really heat up over the weekend. There's already been a run on the banks, and they have not come to any kind of a resolution. So I think that the fundamentals are in play for that, but that's going to have some global echoes and repercussions in a whole lot of other markets. I am hoping for a really good or peaceful resolvement of the crisis, although I find it very, very difficult or plausible to put together any kinds of scenarios that seem logical in terms of being the way that this whole scenario unfolds, that is in a real positive light, because I don't know how Greece is going to repay a debt structure that they simply don't have the capital to do, nor are willing to or able to initiate the reforms that would really necessitate any kind of a shift within the way that government spends money and takes money in. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow for the weekly wrap-up in trending markets. Bye-bye.